So, can anybody remember from the last class what were the three reasons why money is more valuable in the future? Or sorry, is more valuable now than in the future? Inflation. Inflation. Risk. Real interest rate. Okay, so how do we know inflation for the future? How can we know how much inflation will be next year? If I want to find out how much is inflation next year, how can I find out this information? Can I predict the future exactly? No, so how can I get a good guess about inflation for next year? How much do you think inflation will be next year in Korea? 50%? 5%. About 5%? How much was inflation last year in Korea? About 3%. In the US, how much was inflation? About 2%. In Europe, about 2%. In Japan, 0% maybe. In Russia, last year inflation was 10%. Okay. So, in times of crisis or economic problems, we can have higher rates of inflation. So, how can we know? My question is, how can we know what inflation will be? Or where can we get that kind of information from? What do you think inflation will be next year in Russia? How much do you think inflation will be next year?
We hope it will be about 5%.
Okay. So it's higher than Korea. It could be up to 15. So if you want to find out, where are you going to find out that information?
Maybe some government website.
Okay, so we can find out the opinion of experts, right? What kind of experts do we have in the world? What kind of financial experts do we have? We have central banks. Okay, so the Russian central bank, they do a lot of research. They're the ones who told us how much inflation was last year. They check the price of all the goods, like milk and rent, okay, and bicycles. And they saw how much did the bicycles get more expensive last year. Then they also estimate for next year. Outside of the country's central bank, we also have the IMF. The IMF will make some forecast. Do you understand forecast? It's a little bit like guess, but they use research and historical prices to make a forecast for the future. Is the central bank or the IMF always correct? No, they can be wrong sometimes, right? They can make mistakes, but that's like the best guess based on the past. Another way we can figure out inflation is we can look at what does the market think. So if we look at the market, we look at the government bonds. So people buy and sell government bonds, okay? So in government bonds, we think there's not much risk. Different countries don't have different risk, right? If I invest in Russian government bonds, do you think the Russian government will pay me back the money after 10 years?
Yes.
Yes, right? I don't think Russia is going to default, but Russia would be rated lower then another country like Germany is AAA, or Finland is AAA, right? So there is some risk there, right? But we can calculate this risk based on the rating. If one government is AA and another government is B, we can have a table. So if you're B, you get plus 2% compared to A. Okay, we have a table that we can do that. So if we say people are buying and selling government bonds, so constantly buying and selling government bonds, so we can get an idea of what people expect the real interest rate and inflation by looking at government bonds. So the main government bond we look at in the world is the US dollar, because the US dollar is the most used currency in the world. It's the world reserve currency. Also, the US has a very strong economy. Okay? So we expect that the US government can pay us back the money. So if we are going to look at an investment that is no risk, we're calling the US government bond as no risk investment for US dollars. What would be a no risk investment in euros? You invest money in euros and there's no risk. What do you want to invest in? If I want to invest in dollars with no risk, I invest in US government bonds. Okay? If I want to invest in euros with no risk, what will I invest in?
European Union.
Does the European Union have a government bond? Not yet. We hope in the future. Right now, countries like Greece and Italy want to have a European Union government bond, but we don't have a European Union strong government, so Germany and Finland and the Netherlands don't agree. So every country has its own government bond in Europe. So if I want to find a risk-free investment in Europe, what should I invest in? Invest in Greece government bonds?
No, maybe Germany.
Yes, German government bonds is the base in Europe, okay? So people want a risk-free investment in Europe, they invest in German government bonds. What about Japanese yen? I want a risk-free investment in Japanese yen. What should I invest in? Should I invest in Sony? Is that a risk-free investment? In the US, I buy US government bonds for a risk-free investment in dollars. In Europe, I invest in German government bonds for a risk-free investment in euros. If I want a risk-free investment in Japanese yen, what do I need to invest in? Japanese government bonds. If I want a risk-free investment in Britain, in UK pounds, what should I invest in? If I want a risk-free investment in UK pounds, what should I invest in? So, do we have to go through it again? Or can somebody answer me? If we want a risk-free investment in US dollars, we have to invest in US government bonds. If we want a risk-free investment in euros, we have to invest in German government bonds. If we want a risk-free investment in Japanese yen, we invest in Japanese government bonds. If we want a risk-free investment in UK pounds, what do we need to invest in? UK government bonds, okay? Is everybody able to answer that question? Okay, that's important. Okay, we see the government bond usually as risk-free for developed countries, okay, who have a history of repaying their bonds. For example, Greece has a history of not repaying its bonds, so that's not a risk-free government bond, okay? But Germany or Japan, in the modern history, they repay their bonds. So that's an important idea in finance. The idea that if I have cash today, if I put the cash under my bed, right, I get 0% return. But if I invest my cash in a government bond, I'm going to get some return, 2% or 3%, and I don't have any risk. Okay? If I put money under my bed, do I have risk? Yes, what kind of risk?
Maybe you will be robbed.
Yes, somebody can come and take my money from under my bed. Okay? So, anyway, we say that investing in the US government bond is no risk, right? And we get a return. So, of course, you're going to answer me now. If I ask you now, do you want $100 this year or $100 next year? Of course you're going to say this year, because you can invest $100 in US government bonds with no risk, and you can get $102 or $103 back next year. Okay? So, it's an important theory to understand in finance, okay? That there is a risk-free investment which gives us a return every year. So the US government bond then has no risk. So the reason it's more valuable next year is inflation and the real interest rate. So if we know the real interest rate, then we can know what the market thinks inflation will be. Because the market are buying and selling US government bonds. So let's have a look at the website of Bloomberg. So do you know Bloomberg? Bloomberg is a business website from New York. Here we can find the information. Markets, we're thinking about markets. We're looking at rates and bonds. So we go to the Bloomberg homepage, news, markets is second. A lot of business news is about markets, okay? What kind of markets do we have? We have, if we go roll over markets, we have stock markets, currency markets, okay? Commodities like oil, rates and bonds, okay? Bonds we explained in the last week. We should understand what a bond is, okay? Lending money to a company or government. So under rates and bonds, we have US bonds, UK bonds, German bonds, Japanese bonds. So I just spoke to you about the 4 most important currencies in the world. The US dollar, okay? The next biggest currency is the euro. Okay, then after the euro we have pounds and Japanese yen. Then below here we have Australia. Okay? So these are the most important government bonds, which gives us a risk-free rate for each currency. So let's click on US bonds. They're the ones we're interested in. So here it can look a little bit complicated. The US government sells different types of bonds. It sells what they call T-bills, treasury bills for a short term, and then the longer term is called a bond. So the most common one used in finance is 10-year. 10-year bond, we can see here. So they have 3-month to 30-year bonds. Okay? So this is a coupon we talked about before. Coupon is like they pay you this much every year. And then this is the price. Is it selling for 100% of its value, less than 100%, more than 100% of its value? Okay, so we said that these, first of all, these are sold in an auction. A 10-year bond with 2% coupon, they will give you 2% every year. And then we sell this at an auction. Let's say it's for $100 million. So people currently are paying $98 million for this, right? It's a lower percentage. So the most important number is this. This is the yield. So we can calculate the yield is 2.12%. So people are paying slightly less for the bond than its face value. And it pays us, the government is giving us 2% a year. So the value of the bond is about 2.12% a year. So this is what people expect. If they invest in the US government bond for 10 years, They want to get back 2%, 2.12% every year. Can you understand this idea? If you put your money in the bank, how much percent will you get every year? 2%? Yes. Do you think inflation is higher in Korea or in the US? Where is inflation higher, Korea or the US, usually? Korea, right? Korea has higher inflation than the US. So if I have 2% on the Korean won, it's not as good as 2% on the US dollar, right? Because inflation in Korea next year could be 3%. So if inflation in Korea is 3% and I'm getting 2% interest, then the real value of my money is going down, right? So in the US we said that inflation is about 2%. So we have this interesting bond in the US, which we don't have in Korea. It's called Treasury Inflation Protected Securities, or TIPS. So what this means is that the US government is going to give you your money back at the end of 10 years, right? And they're also going to pay you inflation every year. So whatever the inflation is, the government will pay you. Inflation is 5%, the government will pay you 5%, right? Then people buy these bonds. And then we can see that for the 10-year bond, this has a yield of 0.41%. So this bond, the government is paying me my money back, plus the government is paying me inflation. We don't know what it is now, but the government has agreed when we figure out what inflation is, say inflation in 2015 is 2%, then I will pay you 2% into your bank account, okay? So if the government is, if this bond has no risk, and the government is going to match inflation, what is the 0.41%? What is that? Can anybody tell me? This bond has no risk, it has no inflation, because the government is going to pay me the same as inflation is. So why is the money more valuable now than in the future? The government still has to pay me 0.41%.
You can put money in bank and the interest will be more than 2%.
Okay, so what's that called? So the government, we have no risk. The government is compensating us for inflation, so we don't have to worry about inflation. So what's that called? The extra money the government has to give us. So that the money is more valuable today than the future. Can anybody tell me? It's called the real interest rate. Okay? So we said there are three things why money is more valuable in the future than today. Inflation. In this bond, we don't have to worry about inflation. Okay? The US government is going to pay us. Inflation is 50%, they'll pay us 50%. Okay? This is called inflation protected. Do you understand protection? Yes? So this bond is inflation protected. Okay? So this is a safer way to invest. Okay? You're protected against inflation and against risk. But it's not zero, right? For the 10 years, it's 0.41%. And the reason for this is the real interest rate. People prefer to consume now than consume in the future. Okay? It's not inflation and it's not risk. It's I prefer to consume now than consume in the future. Okay? It's I prefer to have an apple now than an apple tomorrow or next week. That's what this number is. So this is an important number, and we can use this number for other countries too, because other countries don't really have this system. Okay? The US financial market, we're going to see in this course, is generally more developed than the other countries. Okay? So the US has more financial products. Okay? So we can just take this as for the purpose of a kind of real interest rate in the world. Okay? There are other factors which affect the US government bond, like it's a safe haven, those kind of things, okay? But we can look at this 10-year. Then if we know the real interest rate is currently is 0.41%, okay? And we know that there is no risk on the bond, and we know that this 10-year bond is 2.12%, then my next question is, this is the 10-year with inflation, and then this is 10-year with no inflation protected. My question is, what does the market expect inflation to be in the US each year for the next 10 years? So we have two bonds. One bond is including inflation. The other bond is not including inflation. So can anybody tell me what should the inflation rate be? Where did you get 2 from? Okay, it's lower than 2. .2, no. So this bond is including inflation. Do you understand including? Okay, this bond is not including inflation. So how much is inflation?
1.71.
Yes, okay. This bond including inflation minus this bond not including inflation. So 2.12 minus 0.41 is equals to 1.71. Okay? So if we look at this bond, we're going to have the real interest rate 0.14%. Okay, we risk 0, no risk, and inflation 1.71%. Okay, inflation plus the real interest rate is equals to the yields or the return that we get on a government bond. Okay, so we can see this is the market idea. This is what the market thinks will be inflation in the US next year, and the next year, and the next year. The average over the next 10 years, they think, will be 1.71%. Okay, we can do this for a Korean government bond. Okay, if we find a Korean government bond and take away the real interest rate, which we said is similar all around the world, this is just people's preference to consume now instead of consuming tomorrow, then we can find expected inflation for Korea or Russia. Okay? So we may have to add something for risk for another country, right? But we can make this kind of calculation by looking at government bonds, and we can find out what is the market expect inflation to be. Okay? We can also look at the opinion of the experts. This is going to be a little bit different. Who do you trust more, the opinion of the experts or the people in the markets, buying and selling? Which is more accurate, do you think? People who are putting their money at risk, buying and selling, or the experts who are giving their opinion based on research? Okay, so some people have different opinions. Some people trust the markets. They say, those people are using their money. They're putting their money up front and risking their money. So they must be more concentrated, okay? And then they say that some people prefer the experts. They say they're smarter. They have a PhD degree. Maybe these guys are just traders, don't have a PhD degree, right? So they're smarter, so they did the research. They went to the best universities, so they should know better. Okay? So different people have different opinions, but we should know both, right? We should know the market's idea, and we should know the expert's idea, generally. And then we can get an idea between the expert's opinion and the market's opinion. So we can see that money has different value over time due to these three reasons and explained with the government bonds. So then let's go into the time value of money to discuss in more detail. So I think it's a good idea for you to check about the tips after the class in your own time. Treasury inflated protection securities, right? You can check about that on Naver or on Google, okay? Maybe we didn't explain in detail, we don't have enough time, so it's okay if you don't understand exactly about tips, but you can search for that, right? Find out more about that. It's related to the real interest rate. So we're going to talk about present value in this class. So present value is a concept that is simple to compute. So we're going to get money in the future, or we're going to pay money in the future. And we want to know how much is that worth in today's money. So some examples of that are buying a house, okay? Saving for our child's education, okay? How much money will we need in 10 years to pay for the child's education? Then how much do we need to save now, today? Estimating income in retirement. Do you understand retirement? What does retirement mean? Bye-bye.
When you are old and you stop working.
Yes, when you're old and you stop working, right? So these are decisions that everybody makes in their life. Okay, so this time value of money is useful for everyday life. Okay, then if you work in a bank, you're going to have to use a more complicated, or if you work in the financial management, you need to use some more complicated equations. Okay, we will need to decide which project should we invest in. Okay, so next year we're going to get $200. Year 2, $400. Year 3, $1,000. Okay, so what's that money worth in today's money? Can help us to decide whether to invest or not. So we said that these are the three reasons why money is more valuable today. We made this calculation. We can change the numbers here. Real interest rate plus inflation rate is equals to the market rate on the 10-year government bond. Okay? This is risk-free, eliminating risk. Okay? Just inflation plus the real interest rate equals government bond rate, 10-year government bond rate of return. So we're going to look at some equations. So we should look at these symbols first so we can understand the symbols. PV, present value. FV, future value. CF, cash flow. Cash flow means money going in or coming out, right? Money is moving, flow. A is annuity. So what is an annuity? An annuity is a constant cash flow over several periods. Can anybody give me an example of an annuity? Where we get the same money coming in or going out over a certain period. So if we buy a bond, we get the coupon on the bond, right? So we have a bond coupon. We buy a bond from the US government at the 2% coupon. Okay? We're going to get 2% every year for 10 years. Exactly the same amount. Okay? So the bond is $100. We'll get year 1. How much will we get? 2. Year 2? 2. Year 3? 2. Year 4? 2. Right? So an annuity is the same cash flow over several periods. Okay? So just we need to know this for calculation. We can make calculations if we know we're going to get the same money coming in or going out. Okay? It could be the same for you. If you get a loan, okay, and you don't pay back the principal, you're just paying the interest. You're paying the same amount every month. Okay? So the next one is G, is a growth rate, expected growth rate. And N is just time. N is time. Number of years or number of months. So we're going to look at an example of present value. So say that you could get either $15,000 today or $18,000 4 years later. Which one would you choose? This is not $15,000 today or $15,000 later. $15,000 today or $18,000 in 4 years. Which one would you choose?
18,000.
18,000. What would you like to know before you make your decision?
Inflation.
Okay, so you'd like to know inflation, you'd like to know the real interest rate, and you'd like to know the risk. Okay? If you know those things, then you can make a wiser decision. Okay? So, if we just know that, for example, the interest rate is 4% at the moment, we can deposit this money in the bank, and we can get 4% interest. Okay? Then we can use this interest rate as inflation and risk and so on. Okay? So we call this our discount rate. And then we can use an equation. We can use an equation to see the future value of 15,000, which is going to be, we get 4% a year, right? So we make this equation. 15,000, 1 plus 0.04. 4% is 0.04. To the times of t. What's t in this case?
It's period.
Period. So what's the number? 4, right? So can you do that calculation? Do you have a calculator? Perhaps if you don't, on your phone you have a calculator. Right? So try to do this calculation. Find the future value of 15,000. So if you don't, you should have a calculator on your phone, right? If you don't have a calculator, so you can try the calculation. Cash flow at 0 is 15,000. 1, or is the interest rate. Okay? 4%. 0.04. Time is the years, 4 years. Okay? So I should see people not looking at me. You should be looking at your calculator, doing the calculation. Okay? 17,548. So we have 15,000 multiplied by 1.04. What's this? 1.04 to the power of 4. What's this? 15,000 multiplied by 1.169 equals 17,547. So which do you prefer? Put your money in the bank, you'll get this much money after 4 years. Or I'll give you 18,000 after 4 years. Which do you prefer? 18,000, right? Some smart person might say, no, give me the money now, I'll invest it in stocks and I'll make more money, right? But most people would say, I can get 4% with no risk, right? So I'll just take the 18,000, please. Okay, 18,000 we can say is no risk either. Okay, just for this example. So it's important that you follow these calculations. okay, that you don't zone out, because we're going to be moving on to the next one, right? And you will need to do this calculation and also for the exam, because basically you cannot get some pass grade in financial management if you cannot simply tell me the answer to this question. Okay, then for example, I can't give you a pass grade. This is a very simple question. Okay, is this money 18,000 in 4 years more valuable if the interest rate is 4%? Okay, so I'm asking you to pay attention and do the calculation yourself. That's the best way to learn. Okay, then it's going to be easier when it comes to the exam. Okay, so then let's try to find, we can do this the other way around, okay? We can find the present value of the future cash flow. Okay, so we put the future cash flow here, and we already calculated this. 1 plus r to the power of 4 is 1.169. So we can change it around. We can put on the top line 18,000, the future cash flow, right? And divide by 1.169. That will tell us the present value of 18,000, right? So what is the answer to this one? 15,397. So this is my present value of 18,000. Okay? So 18,000 in 4 years. How much is it worth in today's money? That's the question it answers. Okay? It's worth 15,397 in today's money. Okay? So that's better than 15,000 in today's money. So I'm going to choose that option. Okay? So this is just simple present value. I have this much money coming in 4 years. How much is this in today's money? It depends. It depends on the interest rate. Okay? What is the interest rate? Then I can make a calculation, and then I can say how much it's worth in today's money. If the interest rate was not 4%, if the interest rate was 10%, what do you think? Would you prefer 15,000 today or 18,000 in 4 years? You don't have to do the calculation. 15,000 today, of course, right? You're going to get 10% interest every year. It's going to be more than 18,000. So, from this calculation, we know that our choice is between receiving 15,000 or 15,386 today, or 17,500 and 18,000 in 4 years. Of course, we should choose to postpone the payment for 4 years. So, we have to be careful as well with compounding. Do you understand compounding? Compounding means if we get some, if we pay the interest today, then we can add on the interest and then we can get even more interest. So the best way to explain this is with a yearly rate. Okay? So if we get paid 12 monthly payments of a 4% interest rate, okay, we get paid monthly, then in the end, the interest rate is slightly higher than if we get paid annually. So, again, if you work in a bank, that's an important thing to know. If people pay interest monthly rather than yearly, then if we say that we have a 4% rate for the year, how much is that for 1 month? What's 4 divided by 12? You have a calculator?
0.33 in period.
0.33, right? Okay, so we are going to pay, if that 4% is already 0.04, right? But anyway, we're going to pay this much percent a month. Okay? So if we pay this much percent a month, we're going to have month 1, month 2, month 3. Okay? So what's going to happen is here we pay interest. Then on month 2 we're going to have the premium plus interest. So we're going to get slightly higher, okay? Because now this was just premium here, but now that was premium plus interest from month 1. Okay, and then this is going to be slightly higher, and then slightly higher and slightly higher. So in the end, we can make a calculation, and we call this the effective interest rate. This is 4.07% for 4, right? There's an equation we can make. 1 plus the annual interest rate over n, which is 12 in this case, 12 months, minus 1. So this is an equation we can learn. If we pay monthly instead of yearly, if we pay our interest monthly instead of yearly, so for example, if I'm paying back a loan, the mortgage for my house, for example, it's better for me to pay yearly. Say I'm paying 4%. I pay 4% at the end of the year. That's better than for me to pay every month 0.33%. Okay? Because the money I paid in January, I could have put in the bank and got some interest. But I didn't, right? I had to pay it earlier. So in the end, my interest rate on my loan is going to be slightly higher than if I pay once a year. So if we stick in, for example, 10%, if we have annual rate, it's just 10%. If we pay twice a year, say we pay in June and then we pay in December, the rate is actually 10.25%. Okay, because the money we paid in June, we lost the interest on this money if we had kept it until the end of the year. And then if we paid monthly, a 10% interest rate changes to 10.47% interest rate. Okay, using this equation. So if we pay daily, if we pay our interest daily, it's even higher, it's 10.51%. So just if a bank tells you that your mortgage rate is 4% a year, right? Then you get the monthly payment, it could be slightly higher because you pay monthly. You're losing the advantage of having your money deposited in the bank. This is compounding. So let's just test ourselves on these, what we just talked about. So let's check present value. So what is the present value of $1,000 we expect to receive in 10 years, or sorry, in 3 years, with an interest rate of 10%? So in 3 years, we're going to get $1,000. So your mother tells you, I'll give you $1,000 when you graduate after 3 years, okay? But if you want to figure out how much is that worth in today's money, okay, the interest rate is 10%, so can you tell me the answer? Okay, we need to look back at the equations first. So which equation are we going to use? Are we looking for the future value of current cash flow or the present value of a future cash flow? Present value of a future cash flow. Okay, so we're going to write down this equation. You need to use this equation. So the future cash flow over 1 plus the interest rate to the power of t. So write down this equation, right? We're going to need it to answer the question. Unless you have the notes. If you have the notes, then you don't need to write it down. Okay, so then you can make the calculation. And question 2, What is the future value of 10,000 today in 10 years with a compound interest rate of 3% paid yearly? So in this case, which equation do we need to use for question 2? For question 2, we need to use this one, right? So you can write down this one for question 2. Cash flow today times 1 plus the interest rate power of time. Okay? So you can, the other equation is for question 2, right? So you need to write down this equation. So sometimes people make this kind of thing too complicated, okay? It's quite simple. All you need to do is put the right number in the right place and make the calculation, okay? So cash flow 0, present value. What's your present value? Put the number here, okay? Then 1 plus the interest rate, just put the number here, okay? What's time? Just write the number here and then do the calculation, okay? Doesn't have to be over complicated. So just first write down the equation, then put the numbers into the right place in the equation, okay? And carry out the calculation.
Interest from.
Okay, so it's the break time, so let's take a break for 10 minutes and then we can continue. Finish the question after the break.